Talking, of course, of what is happening in terms of the earnings front then, Aberdeen saw higher net outflows, of course, the asset manager here in the UK than expected in the first half of the year. The £500 billion asset manager has been going through a period of transformation under CEO Stephen Bird, who has restructured different parts of the business since his appointment in 2020. Very pleased to say we are now joined by Aberdeen's CEO, Stephen Bird, who we just mentioned there, of course, took over in 2020. Stephen, good morning. Let's start with your reaction to the results with a particular focus on outflows coming in higher than some of the estimates. Do you think you're starting to see a slowdown then in the months and quarters ahead? Are outflows going to start to slow? How concerned are you about the pace of outflows from the business?
Well, good morning, Tom. Great to see you, and thank you for having me. So let's just unpeel it a little bit. What we're doing is building a stronger Aberdeen. You're absolutely right. I took over a company that was a long-term insurance and pensions business, and what we now have is three divisions: investments, advisor, and personal. In the half, let's just deal with the numbers. In the first half, we grew revenues 4%, and we grew earnings by 10%. That's a really good performance in this type of environment, a very difficult environment. And it's a testimony to the stronger business model. Why were we able to grow revenues and earnings in the half? Because the strength within our advisor business and within the personal business, these are two UK savings and wealth platform businesses, was able to offset the challenges within the investing business. Now, on flows, we had less than 1% outflow for the whole business. That's actually a really good performance in the history of Aberdeen, because we have been challenged as a business with outflows. Now, you've got to unpeel the outflows. We sold very well in the quarter. We had 22.1 billion of gross flows within the investments business. We actually had positive flows within Interactive Investor of 1.8 billion. That's important because we acquired Interactive Investor last year, and the strength of that business is showing through in these results. Now, what that demonstrates is we're always advising clients. The first rule of wealth management is to diversify. We have a diversified business model that is built to be able to sustain different market cycles. We know we have an interest rate cycle. We know we have a bear and bull growth cycle. We have a credit cycle. What you want to do is build a business that's got the shape to be able to drive through cycle profitability. So we delivered revenue and earnings growth in the half. We did more than that. We covered the cost of our dividend in the half with adjusted capital generation. And this morning, we were able to announce that we have upsized the buyback. So we committed to 150 million buyback in the first half of the year. That's now almost complete. And we announced this morning, we've upsized that to 300 million. And if you look at the performance of the firm, we are a top performer in the FTSE over the last year to date and last 12 months. And that's a tribute to building a business that is a stronger business model.
Stephen, good morning. I love it. I love the enthusiasm, the sales pitch. You put a very good spin on these numbers. And look, there are some good numbers there in terms of the profit revenue side. The outflows are still worrying, but I understand the history of the last couple of years since you've come in has been restructuring the business, and it's slowing those outflows. So I hear you on the story there. I hear you on the stock performance as well. And as you say, it's great on the buyback. I'm curious, though. I'm not sure if you've seen this, but there's a story out saying you're actually the FTSE 100's lowest rated stock in terms of analyst ratings. Now, I don't want to go on a tangent about equity analysts out there because I might be on the same side as you on this one, but you have 12 sell ratings and no buy ratings. What is it that all these analysts are missing? You've pointed out that your stock is outperforming. Clearly, all these analysts don't think it should be. What is it that they're all missing in your stock price?
Well, largely what happens is analysts are focusing on us as a life and pensions business, when in fact what we've done is we have changed the shape of the business. There are three divisions in this company, and you have to be able to look at the performance of each of the businesses. So the advisor business and the personal business, the power of those businesses has offset the results within the traditional active asset management business. But we've got to think about the different communities. Our shareholders, they are happy. The investors who own the stock have obviously benefited from being invested with us. And I'm going to be briefing the analysts today, but I'm also going to go around all of our individual institutional holders this week, because we're a company that takes the message of the new model to the street. We know that when you're in transition, not everybody gets it right away, but we think that our clients understand what we're doing. We are, and we're delivering the right things. Let me point out a few things about the business, because the numbers are the numbers. What's important for me to do as a CEO, what I got to do is configure the business for growth. What did we do in the half? We upgraded technology in 2 of our divisions. So the advisor business upgraded technology. That was the first time that we had upgraded technology since 2006. So a substantial tech upgrade called the Advisor Experience Program. That was delivered in February. Secondly, Interactive Investor completely renewed their front-end technology, both on web and in-app. And they did that so that we have an agile tech stack, so that we can continually update and renew services and price points, because we are the challenger in this marketplace. We grew 1.8 billion in Interactive Investor in the half, and we've seen substantial growth within our SIP, self-invested personal pension. Why is that? Because in a market where there is cost of living pressure, where there is rising interest rates, clients are focused on the cost of investing. We are the challenger. We provide better investing services at lower cost, and that augurs well for the future.
Stephen, I want to get a question in about this journey that you're on then, the restructuring. Where are you? Are you coming to an end of this plan? And is a breakup ultimately on the cards for Aberdeen?
Well, if you look at what I've just described, essentially what we've built is a business. What is Aberdeen? It's an investing products and platforms. So content.
But you could spin off these 3 units, Stephen.
Why would you want to do that? Look at how we've performed in the last 12 months. Look at revenue growth, look at earnings growth, look at stock performance. The market will catch up with the story. We've outperformed every asset manager from a stock price performance in the last 12 months across Europe. It's just the beginning of a better business model that we are building. Now, I want to highlight a couple of things. We promised that the costs are too high within the asset manager, and we said that we would reduce cost within the asset manager, and we quantified it. We said we would reduce 75 million of cost this year, and we've confirmed in the half that we're on track to do that. We've confirmed that we're selling well with 22.1 billion of gross sales within the asset manager, and I'm highlighting some significant wins. Incidentally, in the second quarter, we actually grew on a total business basis. We grew in the second quarter. We had net inflow in the second quarter. Notable wins. In the UK, Border to Coast Pension Partners, 4 billion we won in the half. That's won, not yet funded. So that's going to come in the future. We're seeing substantial progress within our real assets franchise. Aberdeen has got 3 broad areas: specialist equities, fixed income, and real assets, the alternatives franchise. Within fixed income, I heard you doing the market commentary there just before I come on. We're seeing rates rising still in the developed world. The emerging markets are already cutting. We are closer to the peak of rates than we were 6 months ago. And the institutional money is beginning to position for peak rates. Why? Because nominal yields are already attractive in bonds. You want to be where the market is going next.
Stephen, I'm going to be interrupted there just because we're running out of time, and I have to say you've delivered a very impressive pitch that I'm sure both your staff and your shareholders will be very happy about. I hope it turns around the outflow story for you at some point soon as well. One quick final question. You've talked about going into private markets, and I'm curious about what exactly a bit more detail on your plans there. Do you have any more deals particularly planned about going into private markets?
Absolutely. So I mentioned the alternatives franchise, 81 billion pounds alternatives franchise, and real assets. And Border to Coast is a real estate investment that they've made with us. we are a very large real estate investor. And we saw, of course, when rates shot up, real estate values shot down, largest correction in over 20 years, more than the GFC. That is an opportunity. And that's why we're now seeing the real assets. So think infrastructure. Think about building tunnels and bridges and energy transition. The energy transition is going to be the largest capital reallocation for the balance of our careers. Very, very important. We're very focused on it. So sustainability is a large part of our heritage and history in this company, and we are focused on being able to take our clients into sustainability. Asia sustainability was one of the areas that we saw significant inflows in the first half. I want to highlight one last thing. We acquired Tekla Capital in the first half. That's out of Boston in the US. It's a health and biotech firm. With that, we get $3.1 billion of assets, but it becomes the basis of a health and biotech business for Aberdeen, an area where we weren't strong. Longevity, aging, health, and the synergy that comes from AI and medical discovery is an area we believe is a trend for the 21st century and one that we want to be invested in.
OK, Stephen, we'll have to get you back on another time to talk about the acquisition plans and potential further consolidation in this space. But we appreciate your time this morning on the back of those results. Aberdeen CEO Stephen Bird on the journey for that asset manager on a day, of course, when we've seen outflows, net outflows in the first half of around £5.2 billion for the first half through to June.